In this video, I'm going to be giving you some tips on how to navigate your way around an economic downturn, which is also known as a recession. You see, no one knows when a recession is really coming, and anyone that claims to know so isn't being 100% honest with you. It is mostly speculation or at best an educated guess. Today, I want to walk you guys through 5 actionable steps on how you can best position yourself in the case of an economic downturn or recession. Hey, what's up you guys? My name is Nas and welcome back to my channel where we talk about all things related to money, business, and personal finance. Today, I want to walk you guys through 5 actionable steps you can take to best position yourself in the case of an economic downturn or market recession. So let's dive right in. The markets had gone down significantly after Q1 2020, as we can see in the S&P 500, where it dropped 30% at its bottom on March 2020 since the beginning of 2020. And all this happened because of how the illness that was going around globally was ravaging the economies of the world. Since March 2020, however, the S&P today has recovered nearly 100%. It has moved from $2,300 and change in March 2020 all the way up to $4,300 and change today. In the last few days, we've actually seen some downtrend in the overall market, especially the growth sector, and this is of some concern to me, and I'll explain why in a little bit. You see, I'm not trying to be pessimistic towards the outlook of the market because I want the markets to prosper. I am invested in these markets right now, but facts don't lie, and the facts I'm going to present here are the 3 main reasons why I think the market outlook moving forward into the future isn't looking too great. You see, there are 3 main reasons why I think the market is due for a correction coming up in the short-term future. Number 1 being, the market always tends to overreact, whether it's good news or bad news. If it's good news, the markets tend to overreact and reach unjustifiable highs, and the exact opposite happens when we have bad news and the market sells off so quick that there's no justification as to why it sold off as much as it did. So this is the general nature of investors. We always tend to overreact when it comes to monetary aspects of things because emotions play a great role with us when it comes to playing around with our money. In this case, coming out of a global pandemic, everyone's "oh, the world is an ending" sigh of relief has been heavily overstated, and we can see that reflection in terms of the market, where the market has gone up exponentially. You see, anytime the market goes up too quick or down too quick, they're always due for a price correction. The values of companies are based on what their future income potential may look like, such as the case of Tesla, where their valuation is actually based off of their income potential several years forward. This is a very important concept to understand because the way the markets have reacted and everything has gone up in price in terms of share prices for companies is because people are thinking that, oh, we're coming out of the pandemic right now and the markets aren't ending, the financial system isn't going to fail, and we're only going to go up higher and higher from here. Well, that pipe dream comes crashing down when you realize that valuations are based off of future income potential for companies. And right now, with all the supply chain restraints that we have had due to this whole global pandemic that we went through, companies are not being able to catch up on their backlog of production and manufacturing. So if they're unable to catch up with their production, how are they going to meet their deliverables and their deliverable deadlines? That's going to impact their bottom line over the short term. So I feel like all the companies that are as overvalued as they are right now are due for a price correction once people realize that these valuations don't make sense, because it may take much longer than what we're assuming it will take for that future income potential to come to fruition. While Jay Powell and the Fed keep saying that inflation here is transitory and it's not going to be runaway inflation, the CPI data month over month has been showing higher than expected inflation data, and when that goes on for 6+ months, it is going to cause some form of panic within the masses in the general public. As this inflation number is growing exponentially month over month and beating inflation data expectations, it's really holding back investors from putting money into these otherwise hot markets right now. I hope we don't see any form of economic downturn coming. However, it is very hard to argue with the historic economic data that shows a very cyclical trend right now. In the unfortunate scenario where we do see an economic recession come to fruition, we need to best prepare ourselves so that we can navigate through those difficult times. So do you guys have a strategy that you use during economic downturns or times of recession with your investments and your cash? If you do, please let me know in the comments down below what your strategy looks like. Quick disclaimer, you guys, I'm not a financial advisor and this is not financial advice. All the content in this video is meant for entertainment purposes and to get you thinking about what if possibilities. With that said, let's get into it. So diving right in, the first thing you should do when preparing for a recession or an economic downturn is you need to have a well understanding of what your net worth is. It is so important to understand what your net worth is, as this will enable you to make the best educated decisions on how to position yourself when it comes time for a recession. So to begin with, you should first figure out where your assets and liabilities lay and how they're allocated. So assets would include your cash, stock, other investments like bonds, mutual funds, real estate, and anything else you may have. And liabilities would include loans, any kind of debt obligations really, car payments, mortgages, student loans, and the list goes on. So mapping out your assets and how they're allocated is so important because it helps you understand the amount of exposure you have in each asset class. For example, if you have a net worth of, let's say, $100,000 and you're 10% allocated in stocks, that's $10,000 in the stock market. Well, it's not unusual during an economic downturn for the stock market to go down by 30-40%. Let's say if the market drops 40%, then you're risking about $4,000 of that 10% allocation in your stock portfolio. So that would be, in the greater scheme of things, about only 4% of your overall net worth of $100,000. Now, this may be a high or low risk based on what your risk potential or risk profile looks like. However, the biggest factor here are your liabilities, and you need to realize that even if an economic downturn were to occur, your debt obligations remain the same. If you have lost your job and lost your source of income during a recessionary period, you still owe money to the banks and your creditors on credit card payments, mortgage payments, and any other form of debt obligations you may have. So it's super duper important to figure out what your monthly liabilities are and how you can position yourself best in the case of the worst case scenario. So essentially, you need to calculate and see if you can afford to hold on to your debt obligations in the worst case scenario of an economic recession where jobs are lost and small businesses shut down. So ideally, you'd want to be doing this net worth analysis on a month-to-month basis in order to stay on top of it. Personally, I love using the app Mint to track my net worth because it collects all my bank account and asset information and compares it against my credit card bills and other debt obligations I may have. This is not a sponsored video by Mint. I just personally love using it, and I would recommend it to all of my friends. See, analyzing your network on a month-to-month basis will help you identify your key weak points in your financial situation and how you can best position yourself in the worst case scenario. So the second actionable step you need to take is save aggressively. If you see that the market has a potential for a downturn coming in the near future, you should start trying to save as aggressively as you possibly can starting today. During market downturns, it's very important for you to be heavy on cash. Cash is king, and I will explain why in a little bit. If you're a millennial like me watching this, I believe that you should try and live as frugally as you possibly can right now for the next couple of years so you can live a life of abundance in the future. Living frugally does not mean that you should deprive yourself at all. All it means is that taking a step back and reassessing your purchases. Reassess whether the purchases you make do actually bring you joy and utility, or if you're just doing these purchases out of boredom and habit. I understand that everyone's financial situation is very, very different and unique, but do try to save as much as you can early on in life so that later down the line you're able to live comfortably. Because if you're spending 100% of your paycheck currently, chances are you're going to have a very difficult time in the case of an economic downturn where jobs are lost and businesses shut down. So you see, living frugally, making intentional choices about your purchases, and sticking to your budget is really going to help you build up that cash reserve so that things are not going to be as tight in the future in the worst case scenarios. So the third actionable step in order to best position yourself in the case of an economic downturn is to make sure that you have an emergency fund. So you want to build up your savings and have an emergency fund at hand because it provides as a safety net in the worst case scenario of a job loss, of business losses, and in the case of medical emergencies, among many other things. Financial advisors will tell you that you should at least have 6 months worth of living expenses saved up in your emergency fund. However, personally, I like to keep about 9 months to a year's worth saved in living expenses should the worst case happen. Of the 5 actionable steps I'm mentioning here today, building an emergency fund is literally the most important thing that you need to prioritize on starting today if you can. Most people don't plan for the worst case scenario and they end up spending 100% of their income on discretionary needs and wants, and they're never preparing for the worst case scenario. In some of these extreme cases where an economic downturn may happen and one doesn't have an emergency fund or are well prepared for an economic downturn, they end up taking on credit card debt among other loans just to barely get by. And by the time they're back up on their feet and the economy recovers, they're so deep in debt that they're barely getting by making the minimum payments on their credit cards. And because these forms of debt have such high interest rates, they're only getting deeper and deeper and deeper into debt over the course of their life. And this can really create a domino effect and cause a downward spiral for most people. So if you can potentially afford to do so, it's so much better to err on the side of caution and prioritize on building up that savings. If there's one thing and only one thing that you take from this video, I hope it's this one. Prioritize on building up an emergency fund as soon as you possibly can. So the fourth actionable step you need to take in order to best position yourself in the case of an economic downturn is making sure that you pay off those high interest debts, such as credit cards. It's super normal to find creditors offering very low interest rates on debt during recessionary periods because they're incentivized by governments to do so. This is done in hopes of getting people to spend more money, get money flowing into the economy, and jumpstart the markets again. This is why it's so important to make sure that you pay off your high interest debts before a recession hits, because you want to be able to take advantage of lower interest rates that are going to be offered during those times. You don't want your creditworthiness weighing you down, because if you have high interest paying debts to begin with, they're not going to loan out as much as they would otherwise. So if you're interested in learning more about how credit works, check out this video I have posted right up here explaining creditworthiness and how you can build up your credit score in the shortest possible time. Again, try paying off your highest interest debt obligations prior to a recessionary period so you're eligible to borrow as much as you can during recessionary periods, taking advantage of those lower interest rates. You can potentially use those lower interest rates to refinance the mortgage on your house or investment properties, or even purchase other assets because the cost of borrowing is at all-time lows essentially. So my fifth and final tip is equip yourself with the understanding of how recessions and economic downturns work. There are literally thousands, if not millions, of articles available online in order to educate yourself on how recessions work, and understanding this will help you understand the impact it may have on your assets during an economic downturn. I don't intend on diving too deep into these topics today, but I will say, when it comes to personal finances or your finances in general, the root cause of your fear comes from not understanding how things work for yourself, or seeing your neighbor who's panic selling all of his stocks and telling you to do the same, or some dude on YouTube that's telling you of darker times ahead. So you see, a better understanding of how economies work during the recession is going to help you avoid falling into the trap that so many fall into by making poor financial decisions just because of fear, doubt, and uncertainty. What I'm saying is, once you have a better understanding of how economies and financial markets work during recessionary periods, you're expected to make decisions based on rationale and logic rather than on emotions. And that is going to set you apart from 99% of other investors in the market. The reason I started this channel was to share my knowledge on personal finances and understanding of financial markets. My goal is to help people make better financial decisions so that they can live a comfortable life in the future. I see so much misinformation out there in the media, and it's leading people in the wrong direction of making poor financial decisions that can take them years, if not decades, to recover from. My goal wasn't to come on here and be pessimistic about the market outlook moving forward in the future. That couldn't be further from the truth. I want to see everyone make money, and I want to be able to make money from the markets. All I'm saying is that history shows that economies are very, very cyclical. Whenever we have long periods of bull markets, a bear market in the foreseeable future is inevitable. I want to help contribute in putting out a good plan of action for when we do see those recessionary periods coming in the foreseeable future, and I hope that you're able to take some positive notes out of this video and implement it into your strategy for times of economic downturns. With that said, you guys, if you stuck around this long, please smash that like button and subscribe to my channel if you haven't done it already, and comment down below and let me know what your strategy is on investing when it comes to recessionary markets. Maybe there's a thing or two that I could learn from you as well. Until next time, bye!